Our team will present on the case of Archegos founder Bill Huang being charged with securities fraud. This case is a significant event in modern finance, highlighting systemic risks and regulatory gaps. Let's dive into what happened, why it happened, and the lessons learned.
So let's start with who Bill Huang is. Bill Huang is a former hedge fund manager and the founder of Archegos Capital Management, a family office that managed his personal wealth. Although Archegos operated privately, it built tens of billions of dollars in exposure through complex derivative instruments. Before Archegos, Huang ran Tiger Asia, a prominent hedge fund. In 2012, he faced regulatory penalties for insider trading and was barred from managing public money. After that, he shifted to running a family office, which required far less regulatory oversight. This structure later allowed him to quietly rebuild and accumulate massive hidden leverage behind the scenes, setting the stage for what followed. At a high level, the Archegos story unfolded over several stages. After 2012, Huang rebuilt through Archegos by using total return swaps to take large, hidden, and highly leveraged positions in a small number of stocks. Banks extended credit without seeing his true exposure. By early 2021, Archegos had turned roughly $10 billion of capital into more than $160 billion of economic exposure. In March 2021, a drop in Viacom CBS triggered margin calls. Archegos couldn't meet them, forcing banks to liquidate positions. Within days, over $100 billion in market value was wiped out, leading to criminal charges in 2022 and Huang's sentencing in 2024. The fraud began with the use of total return swaps. These allow Archegos to gain massive exposure to stocks without actually owning the shares. Because swaps don't require public ownership disclosure, Archegos was able to quietly build outsized positions, in some cases controlling more than half of a company's outstanding shares without regulators or the market noticing. The swaps were spread across multiple prime brokers, so no single bank could see how large or concentrated the positions really were. Archegos favored swaps because they offered anonymity, high leverage, and minimal regulatory visibility compared to direct equity ownership. At the same time, Archegos misled its prime brokers about risk. Each bank was told the portfolio was diversified and manageable. In reality, the same concentrated bets were repeated across multiple banks. As stock prices rose, Archegos borrowed even more to increase its positions, creating extreme leverage that far exceeded normal hedge fund or family office levels. Archegos' aggressive buying also pushed stock prices higher, making the firm appear low risk and encouraging banks to extend even more credit. This created a self-reinforcing cycle. More buying led to higher prices, more credit, and even larger positions. When prices eventually fell, the entire structure collapsed almost instantly. The Archegos collapse involved multiple key stakeholders. At the core were Bill Huang, the founder and CIO of Archegos, and Patrick Halligan, the CFO, both convicted of misleading banks. Archegos' head trader, Scott Becker, later testified for prosecutors and avoided prison. Surrounding them were the prime broker banks, most notably Credit Suisse, which suffered the largest loss and whose governance failures ultimately contributed to its acquisition by UBS. Other banks included Nomura, Morgan Stanley, and Goldman Sachs, all of whom provided swap leverage without seeing Archegos' full exposure. Regulators, led by the US SEC and Department of Justice, later prosecuted the case, exposing major oversight gaps around family offices and derivatives. Finally, the broader market and investors were impacted, including shareholders of affected companies and Credit Suisse investors who bore long-term losses.
In this slide, I will be talking about the impact of Archegos' debacle on the fintech and financial landscape. Firstly, banks such as Credit Suisse, Nomura, and Morgan Stanley incurred billions of losses from their exposures, with Credit Suisse being hit with around US $5.5 billion. Besides that, the Archegos collapse sparked questions about the indirect regulation for family offices and insufficient regulation for derivative exposures and transparency of swap markets. The prime brokerages and banks were scrutinized for the regulatory oversight and insufficient risk management. After the collapse, prime brokerages and banks were recommended some remedial measures by the SEC to prevent similar situations from happening again. They were urged to develop a more holistic view of counterparty risk management, improve risk discipline, improve access to data and technology, and transition clients to dynamic margining. There were several technological and structural factors that contributed to the collapse of Archegos. From the Credit Suisse report, it was mentioned that Credit Suisse failed to adopt automated technology and real-time monitoring for dynamic margining of swaps, which could prevent margin erosion and excessive leverage. It was said that the technology was just implemented but did not include Archegos at the critical time. Next, Archegos' use of total return swaps allowed excessive leverage on particular stock position without any disclosures because underlying securities was not held by Archegos. This structural opacity facilitated hidden risk buildup. Lastly, the use of leverage is a double-edged sword. It amplified returns during market rallies but magnified losses during market declines. Since Archegos was excessively leveraged, a sharp decline in Archegos' portfolio caused a waterfall of margin calls. There were regulatory oversight factors causing the collapse of Archegos. Since Archegos is a family office, it was not subjected to the same disclosure requirements as other investment companies. Archegos' use of swaps also avoided standard disclosure rules. Besides that, Archegos was extended excessive leverage without sufficiently accounting for concentration risk, counterparty exposure, and market risk. Lastly, automated dynamic margining system for swaps went live in Sep 2020. However, Archegos was not listed as a priority to be switched at that time, despite in breach of both PE and scenario limits.
Market and economic conditions played a role in contributing to the collapse of Archegos. Leading up to 2021, liquidity was abundant and rates were low, making leverage cheap. Archegos took advantage of cheap leverage and their family office status, scaling from $10 billion to roughly $160 billion in equity exposure via total return swaps. These positions were heavily concentrated in a few media and tech stocks, such as Viacom CBS, which amplified both potential gains and systemic risk. Widespread bullish sentiment and rising prices masked the fragility of these positions, making it seem like volatility and margin pressure would remain low. The turning point came in March 2021 when Viacom CBS announced a $3 billion share sale. The stock drop triggered margin calls that Archegos couldn't meet, and within hours banks began liquidating collateral, setting off the collapse. Let us dissect some of the social and behavioral factors contributing to Archegos' downfall. First, Archegos took advantage by using total return swaps to build massive leveraged positions without public disclosure, exploiting gaps in reporting rules. Second, competitive pressure among prime brokers encouraged banks to extend more leverage. If one bank resisted, Archegos could take its business elsewhere, weakening risk discipline. Finally, there was clear overconfidence in risk controls, especially at Credit Suisse. It was reported the bank failed to effectively manage risk and didn't act on obvious warning signs about Archegos' positions, showing complacency and a misplaced belief that internal limits would protect them. These behavioral patterns amplified risk and helped set the stage for the sudden unwind. FINMA found that Credit Suisse incurred about $5.5 billion in losses and held roughly $24 billion of concentrated positions on behalf of Archegos, partly because risks weren't properly identified or escalated. ESMA's report shows Archegos built large leveraged derivative positions that were not transparent to regulators or counterparties, which forced fire sale liquidations when positions couldn't meet margin calls. For fintech and capital markets platforms, a few lessons stood out. First, robust adaptive margin models would help to prevent excessive leverage. Second, stress testing with extreme but plausible scenarios would allow firms to anticipate cascading losses. Third, real-time transparency across derivatives and cash positions would help to detect hidden exposures early. Finally, embedding compliance and regulatory requirements into workflows ensures risks are surfaced promptly.
Now, let's look at the potential challenges and opportunities arising from the Archegos case. One major challenge is balancing financial innovation with systemic risk. Tools like derivatives and leverage can enhance returns, but they also introduce fragility into the system. Another challenge is ensuring transparency and accountability without stifling legitimate innovation. Regulators need to strike the right balance. On the flip side, there are clear opportunities. First, fintech can lead the way in developing advanced risk management tools, including real-time monitoring and analytics for leverage and exposure. Second, regulatory reform can create better frameworks for non-traditional entities like family offices, reducing systemic risk. Finally, education and governance for investors and counterparties is critical, helping them understand the hidden risks of complex derivatives and leverage. These steps can turn lessons from Archegos into meaningful progress for the industry. To prevent similar collapses, several areas need improvement. First, regulators should close disclosure loopholes for family offices using swap-based exposures, requiring transparency similar to hedge funds. Second, banks and prime brokers must strengthen internal risk controls, including concentration limits, liquidity stress testing, and counterparty exposure monitoring. Third, the market should adopt real-time or more frequent reporting for derivative exposures, so risks can be detected before they spiral out of control. Fourth, we need industry-wide standards for leverage, diversification, and transparency, especially for alternative investment strategies involving fintech and derivatives. Lastly, investor education is key, helping stakeholders understand that innovative or high-return structures often carry significant hidden risks. These improvements can collectively reduce systemic vulnerabilities and restore confidence in financial markets.